We continue to see estimate-defying profits from Canada's big banks. This morning, CIBC blew past the street with an adjusted earnings per share number of $2.67 and also a drop in oil and gas credit loss provisions to only $2 million. Meanwhile, Toronto Dominion Bank's third quarter profit also exceeded expectations. Joining us for a closer look at the latest Canadian bank earnings is Diana Avigdor. She's portfolio manager and head of trading at Barometer Capital Management. Diana, great to see you. Why don't we begin with let me just throw it open to you. What do you think of these numbers? Which one impressed you the most?
Obviously, they're all coming out and beating on different metrics, everybody to their own speciality. Retail banking seems to be the one underlying metric that lifted all of the 3 out of the 4 banks that so far reported. I think cost controls have been sloppier this quarter, but it doesn't matter because revenue growth has been there and retail banking has increased more than expected, as well as loan growth has been better than expected. So the Canadian consumer is originating mortgages. It's taking loans against their homes through the home equity loan metrics that we've seen. We have seen wealth management and capital markets in the banks where it's the biggest proportion of their returns, such as, for example, Royal Bank. That has been up nicely. And we know in the last quarter there have been several capital raises, and the equity markets, with the exception of the last couple of weeks, have been robust, making new highs. The last couple of weeks arguably have been a little slower, but it is the dog days of summer.
Hi, Diana. It's John.
Hi, John.
I noticed in the notes that you have about a 10% weight in the banks. That would be an underweight relative to the S&P and the TSX, but yet I think you're relatively bullish on the banks. Give me your sense for why an underweight right now.
So we went from almost nothing in the beginning of the year and have slowly legged into these positions one by one. We have about 5 major banks, so Royal, BMO, TD, JP Morgan, and Bank America, and as they work themselves higher, we would be legging in more and more. That's the way we manage money. We leg into things as the relative strength exhibits itself. Some of the things that have made us more positive on the banks is that oil prices are more stable. You recall in the beginning of the year, we were looking at $26 oil, and we felt that the banks' credits, energy, oil, and gas credits, would be at risk. So as the risk-reward balances itself towards the betterment of the banks, we tend to leg in stages. We also had exposure to payment systems. So we feel that in the financial world, there are other things that you can play, not just the actual banks. And then there is also REITs, which tend to have the same exposure to an interest rate environment as the banks. So rather than we don't play relative to an index. So 10% weight within 5 banks, it's 2% each, and it can go higher.
You mentioned a couple of U.S. banks that you are holding as well. Just remind us of those names again and tell us your thoughts on the U.S. banks right now.
So we own JP Morgan and Bank America. There are different reasons why a stock could go up let's talking about the banks. So Bank America, like BMO, for example, is the main driver is cost cutting, and JP Morgan, Royal, main driver is revenue growth, wealth management, and capital markets. Bank America is trading fairly cheap. They've been very successful in cost cutting, Royal and BMO, they're at the 4% yield. JP Morgan is slightly lower. Canadian banks have ROEs that are not to be attained in the U.S., but from an ROE perspective, JP Morgan is up there.
You said earlier this year that the markets, you thought the markets were a buy. What is your view of the markets now, several months later?
We still are positive on the markets. We believe that this is one of those times. We've seen this in terms of market breadth and the way it's situated from an internals perspective, the metrics that we look at. We've seen this in 2009, we've seen this in 2011, and it is not yet overbought. Sure, we've gone from February to now, a pretty decent rally. Doesn't mean we can't pull back on macro risk. Yellen, FOMC, September, election could be sloppy, but the markets look good to us. The internals look good to us. The metrics that we look at in terms of price action and stocks in the positive price action territory looks good. So we're still positive on the markets and are fully invested.
Diana, thanks so much. Have a great day.
Thank you very much, Paul.
Diana Avigdor is Portfolio Manager and Head of Trading at Barometer Capital Management.